Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson Exploring Risk and Return Dynamics. Exploring risk and return dynamics is fundamental to mastering strategic investment. Understanding this interplay allows investors to make informed decisions, balancing potential rewards with inherent risks. Risk and return are two sides of the same coin, and their relationship is crucial in the development of investment strategies. The concept of risk refers to the possibility that the actual return on an investment will be different from its expected return. Return, on the other hand, is the gain or loss generated by an investment over a particular period. The fundamental premise in finance is that higher risk is associated with the potential for higher return. This is encapsulated in the risk-return tradeoff, which posits that to achieve greater returns, an investor must be willing to accept a higher level of risk. Conversely, investments with lower risk typically offer lower returns. This relationship is pivotal to the construction of investment portfolios and the development of strategic investment theories. For instance, stocks historically offer higher returns compared to bonds, but they also come with higher volatility and risk of loss. To quantify risk, various measures are employed, the most common being standard deviation and beta. Standard deviation measures the dispersion of returns around the mean, indicating the volatility of an asset. A higher standard deviation signifies greater volatility and consequently higher risk. Beta, on the other hand, measures an asset's sensitivity to market movements. A beta greater than 1 implies that the asset is more volatile than the market, while a beta less than 1 indicates less volatility. These measures help investors understand the risk characteristics of different assets and construct portfolios that align with their risk tolerance and investment goals. The capital asset pricing model is a foundational theory in finance that elucidates the relationship between risk and return. According to CAPM, the expected return on an asset is equal to the risk-free rate plus a risk premium. The risk premium is determined by the asset's beta and the expected market return minus the risk-free rate. The CAPM formula is expressed as E equals RF plus bet I minus RF, where E is the expected return on asset I, RF is the risk-free rate, DY is the beta of asset I, and E is the expected market return. The CAPM underscores the idea that investors need to be compensated for taking on additional risk, with the risk premium serving as this compensation. Empirical evidence supports the risk-return trade-off, with numerous studies documenting a positive relationship between risk and return. For instance, Fama and French demonstrated that stocks with higher market risk, as measured by beta, tend to have higher average returns. However, they also noted that other factors, such as size and book-to-market ratios, play significant roles in explaining returns. This led to the development of the Fama-French three-factor model, which includes market risk, size, and value factors to better capture the determinants of returns. Diversification is a critical strategy for managing risk while seeking to optimize returns. By holding a diversified portfolio of assets, investors can reduce unsystematic risk, which is the risk specific to individual assets. Systematic risk, which affects the entire market, cannot be eliminated through diversification. The benefits of diversification are rooted in the principle that the returns on different assets are not perfectly correlated. When one asset performs poorly, another may perform well, thereby smoothing out overall portfolio returns. Markowitz's modern portfolio theory formalizes this concept, suggesting that an efficient portfolio maximizes return for a given level of risk by combining assets with low correlations. Behavioral finance adds another layer of understanding to risk and return dynamics by examining how psychological factors influence investor behavior. Traditional finance theories assume that investors are rational and make decisions based on maximizing expected utility. However, behavioral finance recognizes that investors often exhibit irrational behaviors, such as overconfidence, loss aversion, and herd mentality. These behaviors can lead to suboptimal investment decisions and deviations from the predictions of traditional models. For example, investors may overestimate their ability to predict market movements, leading to excessive trading and increased risk. The implications of risk and return dynamics extend to various aspects of strategic investment, including asset allocation, portfolio management, and performance evaluation. Asset allocation involves distributing investments across different asset classes, such as stocks, bonds, and real estate, to achieve a desired risk-return profile. Strategic asset allocation is based on long-term investment goals and risk tolerance, while tactical asset allocation involves short-term adjustments based on market conditions. Portfolio management entails continuously monitoring and rebalancing the portfolio to maintain the desired risk-return balance. Performance evaluation assesses the returns of the portfolio relative to its risk, often using metrics such as the Sharpe ratio, which measures risk-adjusted return. Real-world examples illustrate the practical application of risk and return principles. Consider the case of the 2008 financial crisis, which highlighted the consequences of excessive risk-taking. Leading up to the crisis, many financial institutions engaged in high-risk activities such as subprime mortgage lending and complex derivatives trading in pursuit of higher returns. When the housing market collapsed, these institutions faced massive losses, leading to widespread financial instability. The crisis underscored the importance of understanding and managing risk, as well as the need for robust risk assessment frameworks. Conversely, the long-term success of endowment funds, such as those of major universities, demonstrates the benefits of strategic investment and disciplined risk management. These funds typically employ diversified investment strategies, balancing higher-risk assets, like equities, with lower-risk assets like bonds. By adhering to a long-term investment horizon and maintaining a diversified portfolio, endowment funds have been able to achieve sustainable returns while managing risk effectively. In conclusion, exploring risk and return dynamics is essential for mastering strategic investment. The relationship between risk and return forms the cornerstone of investment theory, guiding the development of strategies aimed at achieving optimal returns while managing risk. Key concepts such as the risk-return tradeoff, CAPM, diversification, and behavioral finance provide a comprehensive framework for understanding and navigating the complexities of investment decisions. Empirical evidence and real-world examples reinforce the practical importance of these principles, highlighting the need for informed and disciplined investment practices. By integrating these insights, investors can enhance their strategic investment capabilities, making more informed decisions that align with their financial goals and risk tolerance. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.